This is going to be a review over June the 23rd, 2020. So, daily chart, another bull day. Gapped up earlier this week. 3 consecutive bull bars. We're trying to close above 3,800. That was and we went above 3,800 today. We'll probably close above it tomorrow. If the bulls are lucky, maybe we'll gap up on the open. But the bulls want to reverse this failed breakout. We broke the downside here on this bar, broke below this low during May 20th and reversed up. The bulls are hoping for the same thing. And for the bears, they got a new low of the day, but the market's starting to go sideways. And as I've said before, the problem the bears have is the overall market's been in a bull trend for many, many years. Bull trends do not reverse into bear trends typically, which means we're probably going to have to do something like this. This is strong enough that we're probably going to go sideways for several years. But sideways could also mean rallies back up to here, sell-offs down to here, rally to a new high, sell-off back down to here. So at this point, the odds were sideways. But look how much higher it went before it came back down to the midpoint. Point is, daily chart, as strong as this sell-off is, it's a leg in a trading range on the higher time frames. Coming into the day, we opened in the middle of the day's range, went sideways, broke to the upside, turned down sharply, sold off, and we tried to break below the low of this trading range, arguably that started over here. We broke below it on the open yesterday, rallied back into it, tried to break below it again today. You can ignore it and just say that this is a double bottom from this breakout. It doesn't really matter. The most important thing is that the market is in. I want to fix that. Most importantly, let me fix this while I'm talking. The market is in a trading range. Just try that. There we go. It's good enough. So trading range here, and is the upper range somewhere up here? Is the lower range down here? It doesn't really matter. It's trading range. Some traders will say it's some sort of wedge top, and it was an expanding triangle bottom or expanding triangle that started going sideways more. Several ways you can call it, several things you can call it. So on the open, first bar of the day, it is a doji bar, but the first problem the bulls have, the first problem bulls and bears have is it's the middle of the range. So if a trader's selling below, their stop's big, probably not going to go much below the low up here. So it's really a bad short below. Tail below the bar, probably buyers below, scaling in lower. But it's a bear bar, and for the bulls that are buying, they may need a stop all the way down here. We could easily sell off and reverse back to the open. Bear bar closing below the low of this bar. Bulls made money buying this low, scaling in. Next bar, big bull bar testing back up here, but again, you've had a reversal down, reversal up, reversal down, and during these bars, you had a lot of up and down. This bar went up, it went down, this bar went down, went back up, this bar went up, then back down. So this is a limit order market. The traders that are buying, that are fading breakouts are being rewarded. They're buying here, scaling in, selling up here, scaling out. They'll buy this low, scaling lower. They'll sell this high, scaling higher, even though it didn't reach that. So the bears have a low 2 short, low 1, low 2, but weak entry bar, bad signal bar. This is a strong bar, but again, it might just be a sell vacuum test of the close of yesterday. We're near yesterday's lows. Traders will buy betting that the bears will not get a consecutive bars. Big bull bar. But the problem the bears have is if I go to a 30-minute chart, there we go. Yeah, this is kind of hard to see, but I want to make the point. 30-minute chart, this is that same close. It's a doji. So do you really want to buy a doji bar in the middle of a tight trading range? That's the equivalent of the open today. Do you really want to sell a bear doji in the middle of the range? So as strong as this bar looks, it's buying at the top of a trading range, and on a 30-minute chart, it's a doji. Weak follow through, possible failed breakout of the first bar of the day, second bar of the day. Bears made money selling below the bar. Now, is it always in short? Probably not. The bulls are getting buying pressure. This is still probably stronger than this, so you may get a second leg up. But again, a lot of bulls that bought here would scalp out and be disappointed by this follow through. And some bulls would rather buy a pullback. There's too much risk of some failed breakout and price going down here. Again, if you're buying up here, where's your stop? That's 1 times your risk. Maybe you put it at a 50% pullback, but what's the probability price goes to here before it goes down to here? And it's closer to 50-50 than you think. So bear breakout, but weak follow through, possible double bottom. It's trading range open. Bears will be disappointed that sold this close. They will probably look to get out break even. And bears disappointed by this follow through. They sold this bear bar. They got out break even around here. Bulls, breakout, pullback buy, higher low, whatever you want to call it. The bulls buying above the bar or buying in the middle of the range right at the open of the day, so it's not ideal. Bull bar, but tail below. Bears made money selling this close, scaling in. Bulls probably will make money buying this low, scaling in lower, and they did. So trading range price action. Now we have a big bull bar closing on its high. So we're getting a lot of bull bars here, 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 and makes me think that we may have to test up. Plus, 3,800 is really close, and it's a magnet, so we'll probably have to get up there at some point today. Weak entry bar, but still may get a small second leg up. Hard to hold short though. We could easily get a bear bar closing on its low, and that'd be a wedge top. 1, 2, 3. Consecutive dojis, and then bulls bought the low, and now we have a bull bar. So 4 consecutive bull bars, but again, forcing traders to buy at the high of the range. Not ideal. Another bull bar, and then a big bear bar. So it's second entry short, failed breakout of these highs. This looks like a leg in a trading range. Bulls that bought, they'll start to become more and more disappointed. And when this bar couldn't close up here, they started bailing out of the trade. Big bear bar, but again, forcing you to sell in the middle of the range. This bar is probably more traders selling up here and bears taking profits than it is. I forgot where I was going with that. This is probably. Give me just 1 second. Let me grab some water. Yeah, this is probably bears will probably take profits down here more than shorting. So they sold up here. They're going to use this sell-off to probably exit shorts and buy them back. Big bull bar, high. You can call it a higher low, double bottom with here. But again, it's an okay buy, but it's not great. Forcing you to sell in the middle of the range. We may test up to this high close, but we may also just get a second leg down. This could just be a vacuum test of the open of the day. Big bull bar, but couldn't close again up here, so consecutive attempts to get a new high here, 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 and here. So here's a breakout, and then we had 3 pushes up. Bulls will probably be disappointed and look to get out at break even on this close. High 1 buy, but weak bear bar. So bears will look to sell the close, sell above the bar, scaling higher, betting that we test back to the open of the day. which is exactly what happened. Big bear bar, but weak doji. So weak high, weak double bottom, probably sellers above. And again, probably will reach the open of the day. So bear bar, outside down, but again, now you're back to the middle of the range. Hard to sell here, but strong enough bear bar is probably at least second leg down. Big bear bar opened with a very small tail, sold off. Good for the bears. You'll probably have a lot of bulls that were trapped who sold. Any bull that bought this low, bought down here, bought on this close, they're trapped, so they'll use any bounce to get out break even. So probably at least second leg down. I don't know if you'll go for a measured move, but traders that are selling, willing to scale in higher, use a stop up here, probably will make money. Bull bar, so not surprising. It's a possible second leg trap, but strong enough, you'll probably have to get at least a micro double bottom. Consecutive bull bars, and then we have a low one short. Might be buyers below, but again, probably strong enough we'll at least have to test this close. Bear bar, somewhat of a surprise, and then a really big bear bar. So the bulls that bought here and scaled in use this bounce to minimize the loss. You'll have to wonder if the same thing could happen here. And one of the problems with buying here is the market may sell off all the way down to there. So consecutive bear bars, probably going a little bit lower. Very big bear bar, probably exhaustion. Strong enough to make me think that we may break to the downside, but the bears need more. It's a possible just failed break out of these lows. Wedge bottom, double bottom, bull bar, but strong enough bear breakout that would probably have to test back down. Another bull bar, another bull bar. Is it always in long? It might be, but this is still a pretty strong breakout. So you've got to wonder if a 50% pullback is enough to, it's a little bit more than 50%, but you have to wonder, I don't know if this is enough to reverse the move up. You'll have bulls that bought here, maybe they bought more lower, they'll use this bounce to get out break even, which they did right there. Bulls that bought this low scaled in, trying to get out break even. Low one short, but after this, probably going to be more in a trading range, and traders buying below things, scaling in lower. And big bull bar, excuse me, let me back up. So I said probably buyers below. Consecutive bear bars, so probably going at least a little bit lower. It's possible the bears get a bear breakout, but, and this is enough of a surprise, you may get a few legs down. However, the bears need to get a breakout of this initial range. So 4 consecutive bear bars, probably at least a second leg down. It's possible this is the second leg down, but it's a micro channel. So again, the bulls need more buying pressure before the market will probably reverse. Another doji. So buyers buying below things, scaling in, making money. Buying this low, scaling in, making money. Buying this low, scaling in, making money. You can call it a low 2 short. You can call it a breakout of a tempo wedge. Big tail below. Again, probably going sideways. This is not what you want to see if you're betting on a breakout. And the bears are trying to break again below the range, but bulls are making money buying below things, which means, and if that's the case, bulls buying for a stop entry will make money at some point as well. Big bull bar, so bulls that bought this low, scaled in anywhere down here, made money. Consecutive bull bars, probably going a little bit higher, probably going to test up to here. This was a reasonable buy, so we may have to test up to here and possibly test back to the open of the day. This is a trading range overall. That's why I marked this blue line. It's an important price level, and if we fail to break below this price, we could easily just vacuum back in the middle of this range. So even though the open of the day seems far away, it's really not that far if this is a trading range. 3 consecutive bull bars, doji, but enough buying pressure that probably buyers below. but we may go sideways for several bars. You can call it a second entry short, maybe a double top with here and here. Tested the moving average, but after this much overlap and where it looks like we're failing to break below this blue line, not a great short, too much risk of buyers somewhere down here and reversal up. And again, same problem. So testing the low close, couldn't quite get to it. Probably buyers down here. Bulls, it's possible bears give up above this bear bar. They'll certainly give up on a bull bar closing on its high. But it's hard to stay short for one, if traders were selling down here, which isn't that great. And then they see this, it's hard to stay short. Bull bar closing on its high, follow through bar closing on its high, trying to break above a bear flag. So a bear flag is the same thing as a trading range. You can call it a breakout of a double bottom, breakout of a double top, breakout of a trading range, breakout of a flag. It's all the same. And a trading range is a pullback, is a with trend pullback and a reversal attempt. So the bears were trying to get a pullback and another leg down. The bulls were trying to get a reversal and they got a higher low. Now they have a breakout. So it's possible we may get a measured move up to here if we get there and it looks strong. And no surprise it's up here. But if we get here and it looks strong, traders will look for other targets. Maybe a measured move based on this. Maybe a measured move based on up here. So usually traders start with the smaller measured move projection and then they look for the bigger and bigger ones. Consecutive bull bars, possible measuring gap, strong enough breakout for a second leg up. Disappointment, but a 4-5 bar micro channel, 3 consecutive bear bars. This is probably just a test of this breakout point. So probably going at least a little bit higher. IOI, you can call it a second entry buy or you can call it a breakout pullback. It doesn't matter. Probably an okay buy. Stop placement's trickier. We could easily fall below this low. So probably want to stop down here, which you can see what happened. It fell below the low and turned back up. Very common in a trading range. Consecutive bull bars, stop probably down here. So maybe some sort of measured move projection, which we're close to, broke strongly above it. So next target, maybe here. 3 consecutive bull bars, getting very close to the open of the day. Probably will reach it and probably at least second leg up. So bears that sold betting on more trading range price action are trapped. They'll use any pullback to avoid a loss. Same thing here. The bears that were buying, the bulls that were buying any of these lows here, 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 they will use this bounce to get out break even. So the bears that sold here, trapped, they're going to use any pullback to get out break even. Bear bar, another bear bar, doji, they're using this bounce to try and get out with a smaller loss. Some bulls will look at the breakout itself, maybe this bar. They'll try and buy a 50% pullback, or they may try and buy a 50% pullback of this bar, which is right there or here. One of the things to mention is that the open of the day is right here, this green line. And we got close to it and immediately turned down. This is probably not enough of a test. So often when the market races to something, has a fairly deep pullback, one has to wonder if it's a buy vacuum test of resistance, the open of the day. And if that's the case, we may have to get closer to it. Tested it, starting to sell off. Bears want some sort of second entry short and a closing of this gap, but after 4 consecutive bull bars, probably buyers below this bar, and the bears need more. 5, and then we got a bear bar here, but again, no one's going to sell below a bar after this many bull bars. Doji bar, but again, same problem. Bad stop entry for the bears, and then a give up bar. Bears tried to form some sort of wedge top here, here, and here. They tried below here. They couldn't even trigger here. So this is a little bit of a surprise. Make it a small second leg up. Testing into the breakout points here. Probably sellers above, but probably late in the day, probably better to wait for a bear bar and then a really big bull bar. It is exhaustion and probably will lead to sideways, but when you get a bar that's that big, the odds are you're going to get a second leg up. Bear bar, so profit taking on this close. Testing really close to 3,800. Probably going to have at least a second leg. Sideways to up. May test the open of the day. This is still a problem for the bears. This is a pretty big give up bar. Disappointed bulls. They bought this close. They'll scale in. Try to get out break even. Bears, maybe they'll sell here. They'd be disappointed they'd sell more higher. This is not a good sell though. Another big bull bar. And then outside down went 1 or 2 ticks above yesterday's high. Sold off. Probably will get back to this close. So some bears will sell more somewhere up here, and get out of break even, which is what happened. Bulls that bought this close, if they didn't scalp out, maybe they bought more lower, they'll get out break even right here. So bulls are not successfully, it's becoming more and more difficult for them to buy closes and just make a profit. They're having to buy, scale in, scalp out. So probably going to start to go sideways to down. Likely target here. May have to get back to the open of the day or close to it before the end of the day, but the bulls are running out of time. The bears are. Bear give up bar and sideways into the close. So overall, limit order, it's trading range open. So limit order market in here, try to break to the upside, but again, most breakouts fail, so probably sellers up here. Big bear bar, and then we broke below something. So here, these traders that were buying lows, they got trapped on this bar, and then another big bear bar. So when you get this, it's similar to this. So, but up here, strong breakout, and there's a few things different about it. For one, this is the beginning of a move, this is later, but the point is, traders will use the bounce to minimize the loss. So the bulls that are on the wrong side of the market during this sell-off will use this bounce to avoid a loss. The bulls that bought anywhere in here during this breakout will use this bounce to avoid a loss. For always in is it's a great method for most people starting out, but it's not a great method in trading ranges. That's because the most efficient method in a trading range is limit orders and scaling in, but most people shouldn't do that because it's challenging. So for always in, it's not ideal. You can buy above this bar, but if you do, wide stop down here, and you hold through all this, you probably don't get out below this bar. You just have to trust your stop, or maybe you buy above here, maybe you buy here. But if you do, traders are forced to decide what they're going to do in here. If you buy, you're disappointed here, and it's hard to get out below this bar, and then you end up getting out below here, and it's a break-even trade. So it's a lot more effective. That's the problem with always in. It's great for this. You buy above this bar, no reason to get out, break out, move your stop down here, maybe you move it below this bar, no reason to get short, no reason to sell, and then you get an upside breakout. But here, you probably have to get out below here. Maybe a bear shorts below this bar. They sell below here. Maybe here, but again, you're selling at what could be the bottom of a trading range. No reason to get out there. Probably at least second leg down, which they got. Strong enough breakout. If a trader did get out above this bar due to consecutive sell climaxes here, here, and here, they probably have to get short again below a bar, but that's hard to do because you're at the bottom of the range. And even though you went a little bit lower, you're probably going to fail somewhere down here. But if someone did go short, they probably get out a couple, maybe above this bar, then get out below a bar. They certainly get out 5 points above this bear bar. Aggressive bulls would go long somewhere in here, or they'd wait for this bar. And pretty much there's no reason to get out. And once you see this, it does make sense to probably go ahead and exit. Or if you don't, you exit below here or below this bar. Someone asked a question about goals, and they said, what's my basic opinion about daily goals? They've heard traders state that daily goals can be counterproductive. They've had a goal for 10 points a day. If they're in a trend from the open, they try and swing as long as they can. And once the positive risk is too much, they move their stop. Anyways, they're just asking about daily goals. I think that's tough to answer because everybody's different, and one's daily goals might be different than someone else's. If someone's starting out, their daily goal is to probably not lose. If someone is, and it varies if someone's swing trading, if someone's scalping. I will say this, I think as far as goals, I think it's better to work on not trying, identifying the market cycle, work on not buying at the top of a trading range, selling at the bottom of a trading range, not trading against a strong trend, as far as, and risk management. And maybe those are more rules, but I think goals they can be tricky because everybody's different. But I would start with, if I was going to have goals, I would start with the goal of trying to figure out the dumb trades, such as buying at the top of the trading range, selling at the bottom, and counter trend trading in a trend.